Hi, welcome to this tutorial on personal finance and financial planning. We're going to be talking about pension plans. That is the difference between two different types of pension plans, the defined contribution plan and the defined benefit plan. Alright, so let's get cracking. Okay, this is what we're going to cover in the tutorial. We're going to have this introduction, then we're going to talk about what pension plans are. Following that, we'll talk about the key differences between defined contribution and defined benefit plans. Next up, we'll be talking about the accounting for the two types of plans. And finally, we'll be talking about the personal finance implications for both types of plans. And then we'll have a conclusion and a wrap-up. Okay, since this is about financial planning, personal finance, and financial advice, I have to give you this disclaimer. The business Accofina and myself, the individual, are not giving personal advice in this video. It is meant to provide factual information for educational purposes. We do not know your personal circumstances and financial goals. Neither Accofina or myself hold an Australian Financial Services Licence, nor are we authorised representatives of an Australian Financial Services Licence holder. That is, we are not a licensed financial advisor. We are not giving personal advice nor general advice. We are only giving factual information. This is general information only and should not be taken as constituting professional advice. You should consider seeking independent legal, financial, taxation, or other advice to check how this information relates to your unique circumstances before taking or not taking any actions. Accofina and myself are not liable for any loss caused, whether due to negligence or otherwise, arising from the use or reliance on the information provided directly or indirectly by this video. Okay, so what are pension plans? In general, they're individual investment accounts to assist funding your retirement. So they're private individual investment accounts. They're generally not funded by the state. They're generally funded by employers or individuals themselves. And the key idea is that individuals in recent times are being encouraged to better fund their own retirement through individual investment accounts. Now, these can reduce the burden on the state while also improving the standard of living in retirement. So in the past, you may have the state or the government provide all pensions and state pensions and retirement income needs for retirees. But in recent decades, there's been a movement towards individuals having their own retirement accounts that hold investment assets within them. Now, these accounts can be funded by employers or individuals themselves. And often they receive favourable taxation treatment. So you may be set up with one if you apply for a tax registration number or a tax file number, or when you begin your working life, you're set up with one of these individual investment accounts. And they do receive favourable taxation treatment. So that's how the government still contributes to your retirement, even within these accounts. It incentivises funding these accounts by making the investments very tax effective. Okay, these accounts have restrictions, limits, or disincentives and penalties on accessing the funds prior to retirement. Pension plan systems are often dependent on the state or national jurisdiction. So this video may be played anywhere in the world, so I have to talk in generalizations. But you'll find specific systems, structures, and rules are based on where you're located. So for example, if you're in the US, you may be familiar with 401k accounts. And 401k accounts have different rules or specific rules applied to them. Here in Australia, we have superannuation accounts. And these superannuation accounts are normally within a superannuation fund, or they are within a superannuation fund, and they can be managed by fund managers or even ourselves or our family members in an SMSF. And in Ireland, you might have a PRSA, which is a personal retirement savings account. Now, they're just three examples, and the point is that they vary all over the world. Okay, but this is what the point of this tutorial is about. Now, no matter where you're located, the consensus view is that there are two distinct types or categories of pension plans. These are the defined contribution plan and the defined benefit plan. These are the two types of plans that are normally occurring wherever you are in the world. And we're going to be talking about the defined contribution plan and the defined benefit plan for the rest of this tutorial. Okay, so what are the key differences between the two types of plans? So there's defined contribution plan first up. And now this is where the employer is only obligated to contribute a set amount each period. There is no guarantee of future benefits for the employee, as the employer is only committed to the contribution. For example, there's the SG minimum 9.5% of earnings in Australia. The employee bears all the investment risk. So let's take a step back. So if you're working for a particular employer who's obligated to contribute to a pension plan as part of your salary, a defined contribution plan only obligates the employer to contribute to your fund. Now, once they've contributed, say 9.5% of earnings in Australia, and they've paid that perhaps in August of 2018, then there is no obligation of the employer beyond that contribution. And this is where the idea of no guarantee of future benefits comes in. Once the contribution is made by the employer, it is completely up to the employee about the performance of that contribution and that investment. So if the employer pays this every quarter for 20 years, and suddenly this is practically impossible, the markets all go to zero, and all of our previous 20 years contributions go to zero as well, then we have no claim on the employer for our retirement income needs. The employee, us, bear all the investment risk after the contribution is made. And that's why it's called a defined contribution plan. If you're confused by any of those explanations, please leave a comment. I'm happy to clarify things. It's always easier to explain things in your head as opposed to into a microphone on the spot. So yeah, feel free to comment if you need any clarification. Now here's the second type of plan. As opposed to a defined contribution plan, this is a defined benefit plan. So it's not about contribution, it's about defined benefits. Now in these types of plans, the employer is obligated to provide an income stream post-retirement, and the employer bears the investment risk. See these plans where prior, all they had to do was put in a contribution. With these plans, the employer is promising a certain level of income once you retire. Now the income stream, or the amount of that income stream once you retire, can be dependent on a variety of factors. So a defined benefit plan may have a formula that incorporates the length of service or your salary retirement, and that could impact how much income you receive once you retire. Now the rules and the construction of these plans are all unique. So let's go to where this important section about the employer bearing the investment risk. So this time, employers aren't guaranteeing that they'll contribute to your fund. They're guaranteeing you that they will provide you an income stream post-retirement. So they're promising a particular income stream, and therefore it's up to the employer to have the assets within the fund to meet these commitments. Now, do you see the difference between the two plans? So one, the employer just contributes and meets their obligations. The other one, the employer must have a certain level of assets to meet the obligation to have a particular income stream in your retirement. Again, if I've explained this poorly, please comment and I can probably explain it with more thought and accuracy in a comment, but I hope you understand. Now, with defined benefit plans, these plans can cause huge liabilities for some companies, and they're being phased out, and defined contribution plans are becoming the standard. So if you look at it from an employer's point of view, they would much rather, or actually not much rather, but they would probably, for financial security, rather to make a contribution today and have no obligations in the future. Under a defined benefit plan, not only do they have to contribute to particular funds today, but they have to manage those funds and make sure that they can meet all the promised income streams for all their particular employees in perpetuity, or at least until all the retirement fund members pass on. So these type of liabilities can be very large for some companies, and is one of the reasons why they're being phased out, and defined contribution plans that are becoming the norm. Okay, so let's talk about accounting for both. So the defined contribution plans have much simpler accounting. And here we're talking about from the employer's financial statement viewpoint. Now, in the employer's financial statement, within the income statement, they'll simply have pension expenses, and there's just the contributions that the employer made in the prior period. And on the balance sheet, there's no impact whatsoever. They don't recognise anything on the balance sheet because there are no assets or liabilities related to their employees' retirement funds. All they had to do was contribute, and then their obligations are met. As for the alternative and the defined benefit plan, these are much more complex accounting, and we won't cover this in detail here. There's even differences in accounting between IFRS and US GAAP. In shorthand, on the income statement, there'll be pension expenses also for defined benefit plans, and these would involve new pensions earned by employees, benefits paid from past employees, plus interest, income, and interest expense from the plan assets. But here's the critical part. This is where the defined benefit plans impacts the balance sheet for employers. Now, on one hand, the retirement fund will have the plan assets. So these are ideally all the contributions that the employer has made into the plan for its employees, for its future obligations. And so on one side, you have the plan assets. On the other side, you have the estimated present value of all pension obligations. And then either you will have a net pension asset or a net pension liability on the balance sheet. So let's work with an example here. Let's say there is a company called Biggles Limited. Biggles Limited has 500 employees, and it has a defined benefit plan for all 500 employees. Now, what Biggles Limited has to do with its financial statement is estimate the present value for all the pension obligations over the retirement lives of those 500 employees. So it would have to calculate, okay, now depending on each of those 500 employees, how much income do we have to pay for each of them in their retirement? And then we bring that back to present value, and then that's our liability in this equation. Now, hopefully, Biggles Limited has been planning for these pension liabilities the whole time, and they would have put particular assets or investments into the plan at previous periods. So on the other side of the equation, they have the plan assets and compares them to the estimated present value of the pension obligation. Now, depending which of those sides is bigger, there'll either be a net pension asset if the plan assets are bigger, or a net pension liability if the present value of the pension obligations is larger. And I hope that makes sense. Alright, so we've done with the accounting side of it. Let's look at the personal finance side. So let's say you're involved in a defined contribution plan, which is a lot of the younger employees nowadays. What you have to do is you have to monitor the performance of your contributions. Now, since the employer has made the contribution, they're obligated to do nothing more. The employee bears the investment risk, so you have to monitor the performance of those contributions. Now, wherever those funds are invested, are they doing what you hope they would do? You've got to also monitor the allocation of the contribution and the total balance of the account funds. So where are these contributions being sent? Many people, when they're young, don't even consider where their pension is being allocated. But you should have some sort of portfolio management strategy throughout your entire working life to work out where your pension contributions are being allocated, whether they're being in defensive assets, growth assets, balance assets, or particular sectors and so forth. But the ultimate responsibility is that the individual must plan for the required balance of these funds for retirement. So you take on board the previous two tips about monitoring the performance of contributions and monitoring their allocation. And you need to adjust your own contributions to meet your target or adjust your number of hours worked. So specifically, you got to determine your post-retirement income needs. How much income do you want to generate in your retirement on your investments that will fund your retirement? Now, given that post-retirement income requirement, you have to estimate the balance needed that should hopefully generate that income. So if you need $100 a year in your retirement as income, which is unrealistically low, then you have to work out, okay, assuming my investments earn me 5% per year and I need $100, then I would need $2,000 in my retirement account for retirement. Given that $2,000 balance you would need for retirement, then it's up to you to plan to reach that balance throughout your working life. So you have to adjust your contributions, you have to adjust your hours worked, you have to monitor how your contributions are performing, and it's up to you as you bear the investment risk to reach that particular required balance once you reach retirement. Okay, as for the personal finance implications for defined benefit plans, so we have employers bearing the investment risk. But sadly, it's no guarantee of plain sailing. It should be up to you to monitor the financial strength of the plan. That is, are there enough plan assets to meet your entire retirement? Now, we've all heard horror stories about retirement funds not being able to meet the pension needs of their defined benefit plans. So you have to monitor to make sure that the financial strength of your plan is adequate. For instance, is there an insurmountable net pension liability that means that your retirement plans won't be met with the required income stream? And this can also mean monitoring the business funding the plan assets. If you worked 40 years at Biggles Limited and you retired then and expected to live another 35 years beyond that, then you might have to monitor how Biggles Limited performs over those 35 years. Because if Biggles Limited goes under, then you might find that your retirement fund no longer has the contributions to build up the assets to fund your retirement. Secondly, you have to monitor communications from the managing entity and the fund management. So stay in the loop of how the assets are performing and being governed. It shouldn't just be a set and forget. So even if the contributions are being made from the business, a market crash may put the plan under pressure. So under these plans, the employer has promised a certain income stream. But if there's simply not enough money in the fund, then something is going to break. So you should monitor the communications, stay in the loop of how things are going, whether there's any warnings or whether the financial strength is good, and also be careful of how they're governed. And this final one's quite important, but try and learn how the rules of your defined benefit plan works. Now, they can be very complicated, and many people use a financial planner or a financial advisor to pick apart how they work, but try and find out what you'll be entitled to under your plan, or any impact when you resign or change jobs. And they're just two examples. There's a number of things you can learn about learning the rules of how your defined benefit plan works. But it'll really help educate yourself and get empowered if you know how your defined benefit plan works. And each one of them is individual. Okay, so let's have this conclusion and wrap up what we've covered. What are pension plans? They are individual retirement investment accounts. What are the key differences between the two types of plans? And we talked about defined contribution plans and defined benefit plans. We spoke about the accounting for both types of plans, and that defined contribution plans have simple accounting, while defined benefit plans have complex accounting and importantly impact the balance sheet of the employer. And finally, we talked about the personal finance implications. And importantly, both types of plans involve retirement planning tasks to be completed by the employee. You should care about it, you shouldn't set it and forget it. You'll really have a better quality of life in retirement if you take control of your retirement pension plan. Okay, that's it. I hope it helped. Best of success. If you enjoyed the video, please subscribe to the channel. Click on a button that should show up or isn't already, or may already be showing now. Or you could watch another one of my tutorials now. Or if neither of those interest you, I'd appreciate just a like of the video. That'd be great. Finally, feel free to comment below if anything needs clarification or if you just want to say hello. That's really important. This isn't a one-way conversation. Again, often what's in my head and what I put down in my notes isn't exactly what comes out when I try to speak into the microphone. So if I've confused anything or jumbled anything, feel free to comment below and I will do my best to clarify anything you ask.